Very good evening and a warm welcome to everyone. We will start around 5:05. We are expecting few more people to join in. So we'll start sharp around 5:05. Welcome all to the part 3 of our transfer pricing series, TP Homebound. And while we are going to have some discussion on the name of this topic, as a legacy, let's spend 5 minutes to have a very quick recap of the past two sessions. Is there no voice? Astha, Iti, you all can't hear me? I just saw a
Uh,
comment, there is no voice. Is
you
it
can
slow?
you are clearly audible, Kinchu.
I'm audible. Okay, thank you. So yes, I was saying let's just spend 5 minutes to have a quick recap of the past two sessions for those who couldn't attend them, and for those who did, it might act as a refresher for you all. So as most of you all know, given how new TP is to the region, conducting only one session would not have done justice. And therefore, what we decided is to have a series of transfer pricing sessions covering all the key topics on which we have received a feedback from our clients that they and the audiences in UAE that they want to decode this. In our first two sessions, we covered two of the most important topics, which one was breaking the myth regarding transfer pricing, wherein we broke 6 myths relating to transfer pricing. Can we? Voice is echoing. Is there any problem in my voice? No, I can continue, right? Okay. So can we have a look at the myths, Asta? We'll just have a quick recap of the myth. Yes. So the first myth being all the businesses in the region, small, medium, M&E, are required to comply with the arm's length pricing principle. Yes, there is some relaxation for maintenance of documents and the reporting, but compliance for ALP is mandatory for all. The second myth, TP rules do apply even when all the entities involved are UAE based. And this is what our session today is going to be about, application of TP rules in the region for both domestic as well as international transactions. Coming to the third myth, even if you don't have any balance outstanding at your end, TP would apply if the transaction has occurred during the tax period. Even if you have squared off that loan, if you have entered in 2024 and square off that loan, then there is a possibility that the interest would apply. Next one, auditors can't help you with transfer pricing. Let me clear this once and for all. Auditors are not going to help you with transfer pricing. Audit sign off doesn't mean transfer pricing compliance. In fact, we have heard from a lot of our clients that auditors aren't even signing off the documents unless they have seen that there is a compliance with transfer pricing. So auditors are not going to be of any help here. Next one, TP documentation. We had an entire session for explaining transfer pricing documentation because it is extremely critical. So it is mandatory that you at least document how you have arrived at your arm's length price. Local file, master file, I know there are thresholds involved, but the bare minimum what is expected from you all is at least you document how you have arrived at your arm's length price. Last and the biggest myth, TP is not a year-end formality. It is a business exercise and it has to be done alongside your business. Can we go to the next slide? So on day 2, my colleague Iti and Asta explained you all the satellite view, the drone view, and the ground view, which is the master file, the local file, and the CBCR. So reporting thresholds are there as to what has to go in your return of income, and there is a rule of 44 and a half which applies when you look at the reporting requirements. Lastly, a lot of people ask, do we need to submit anything now? Do we need to upload local files and master files now? So no, nothing has to be submitted now except your transfer pricing disclosure form, which will go alongside your return of income if you comply with the thresholds. But an important thing to note here is that FTA can request this information within 30 days. And it is impossible to have these information gathered in 30 days once the FTA is requested. And therefore, you cannot wait until the end moment. I know the recap was quick, but it was quick given that we have an entire topic to cover today. So in case you all wish to see the full session, we have got you covered. We do have recordings and you can request the same for us. Our team would be very happy to circulate the recording as well as the presentations to you all. So today's topic, can we have a look at today's topic, Astha? TP homebound. Now you might think this is a very corporate way to say transfer pricing in UAE, but actually it is inspired by real life. And let me tell you all how. Every time I travel to India, my hometown, I forget few rules. Like I keep standing on the left side of the escalator, proudly blocking the way, thinking I'm in UAE, unless some frustrated person asks me to move. Or I patiently wait to cross that road, while my cousin will just grab my hand and run across, yelling, "This isn't Dubai. No one is going to stop you, so just cross." I am already missing the shawarmas and the karak chai. The point here is that same person, different country, but very different rules. What works in UAE would not necessarily work in India or any other country, and vice versa. And that's exactly what's transfer pricing for you. Same global principles, yes. Same old OECD guidelines, arm's length pricing, comparables, but UAE has its own quirks. And if we don't adapt, we are basically standing on the wrong side of transfer pricing escalator. And therefore, it is very important to understand what is TP homebound. That is, what is TP in UAE. And therefore, today we want to take you all to the journey of what's common in UAE transfer pricing. The transactions we all know, we love, and sometimes hate, like management fees, cross charges, markups. It appears magically all in the intercompany invoices. But let's decode what are they. Before we start, I would like you all to do a small exercise. Why don't you all open the chat box and tell us that one intercompany transaction which you always wanted to understand better? Anything which you have seen in your invoices or heard in your meetings and you all want to understand better. We would like to learn from our audience first as to what is TP homebound for them and what is the transaction which they want to decode. There is a request that the audience would like the slides of previous two sessions to be shared here. So yes, we can do that definitely. Okay, there's one response which I got: purchases and sales. Yes, we have that covered because that's the most common transaction. Any other transaction which the audience would like to know about? No one wants to know about the visas, connected person payments. Yes, we have that covered. Anything else? Anything specific? Intercompany loans. Yes, I was waiting for this one. Okay, so we have three specific requests. Oh, one more: shareholders withdrawals. Yes, we have that covered. Management fees, we have that covered. How to find arm's length price between our intercompany transactions. I think we'll have that covered in our next session. Intercompany adjustments, visa facilitation service. Yes, this is most important and most common in this region. Yes, I think we have most of it covered. So I would request my colleague Iti to take you all through what is transfer pricing homebound and some of the most typical transactions in UAE, and then Astha will carry forward. Over to you, Iti and Astha.
Thank you, Kinchan, for giving recap of the previous sessions. This will help us to understand this training in a better way. So before starting this training, I want to get back to basics. I want you to ask something from yourself. Whenever you think about transfer pricing applicability, what comes to your mind? So whatever is coming to your mind, just write that in 3 to 4 words in the chat box. I request you all to please make the session interactive. You can write in 3 to 4 words about transfer pricing applicability. That what is coming to your mind when you think about transfer pricing applicability. Okay, secondment, then arm's length principle, Okay, so benchmarking. Okay, so when I talk about applicability of transfer pricing, most of the people relate transfer pricing to international transactions. That is having international transaction between two related parties, or having a situation where an Indian holding company is selling goods or providing any services to its subsidiary company in UAE. Correct? After all transfer pricing was introduced to prevent profit shifting from high tax jurisdiction to low tax jurisdiction. This is not correct. This is where we are making a huge mistake. We are just relating transfer pricing with international transactions. In UAE, transfer pricing is more than just international transaction. UAE recognized that manipulation of profits can happen within UAE because there are different tax regime for different kind of entities. For mainland entities, there is 9% tax rate. For free zone entities, for those who get qualified, there is 0% tax rate, and there is no personal income tax in UAE. So here in the UAE, transfer pricing doesn't stop at borders. It extends to domestic transactions between related parties as well. So I want you to imagine something. You have got two companies under the same group, say one in Dubai mainland and the other one in free zone, both UAE based, both within the same country, same jurisdiction. They do business with each other. One charges the other below the market rates because, hey, it's all within the family and that too in the same country, right? No, this is not the correct approach. Transfer pricing will apply on these domestic transactions too. Now, at MICS, we call these domestic transactions happening between related parties as TP homebound transactions. And I personally love that term because it captures it perfectly. These are UAE to UAE transactions within the same group, but they are not off the radar. They are very much in scope. So whether you are invoicing from Abu Dhabi to Sharjah or from Javza to Dubai Internet City, if it's between related parties, TP rules will definitely apply. So TP rules will apply on the traditional approach where international transactions are involved, and there is UAE approach where TP will apply on domestic transaction as well. So in short, I can say that transfer pricing isn't just a cross-border issue anymore. In the UAE, it's about what happens in our own backyard. Asta, can we move to the next slide? Yes. So here's we will play a quick game. I will give you the four scenarios and you will tell me whether transfer pricing will apply in each of the scenario. So in first scenario, there are two multi mainland entities and there is some transaction happening between these entities. So I request you all to please respond in the chat box whether transfer pricing will apply in the first scenario or not. So in this case, TP will apply. I think most of the people here have replied the correct answer. But those who have answered no might be thinking, wait, both companies pay the same 9% tax. Then why should TP be applicable? Here's the thing. Under UAE corporate tax law, TP applies whenever there is a transaction between related parties, regardless of where they are located or or what is the tax rate applicable to them. So even if the tax impact appears neutral, you are still required to price the transaction at arm's length and have documentation to support it. Now it's the time to go back to scenario 2, in which the mainland entity is providing services to free zone affiliate. So will TP be applicable in this case? I request you to please respond in the chat box. Yes, so I can see all of us replying yes. So the answer is yes, TP will definitely apply because it is in this case, there's also a difference in tax liability. Mainland is taxed at 9%, while many free zone entities enjoy a 0% tax rate. So, this differentiation in the tax rate opens a door to the profit shifting. That's why TP has covered this situation. Now, in the third scenario, the entities have shifted. Now, the free zone entity is selling goods to mainland entity. Would TP be applicable in this case also? Yes. Yeah. So the answer is correct. TP applies again because direction doesn't matter. What matters is that the transaction is between related parties and the tax outcome could be influenced by how it's priced. Next transaction, there are two free zone entities involved. Both are taxable at 0%. They are having a transaction between them. So TP would be applicable on them. Yes, I can see a lot of yes. So even in this situation, TP will apply even if the entities enjoy the same tax treatment. The law still requires TP compliance if they are related parties. So in short, if you are any kind of entity and in UAE, if you are having transaction between your related parties, TP would be applicable. Now, you may have noticed something on the slide that the last three transactions, these are highlighted by red, while the first was in is in the blue. Why? Because non-compliance in those last three cases can be costly. If a free zone company fails to meet TP requirements, including documentation, it could lose its 0% tax benefit, not just for this year, but for the next 4 years. That is for 5 consecutive years. Therefore, it is very important, especially for while transacting between free zone entity, that transfer pricing is being followed. So please remember this simple rule that if there is the transaction between related party, TP applies no matter where they are based in the UE or they are based outside UE. Now we will discuss some common transactions which are homebound transactions, and we will see that what are transfer pricing implication in these common scenario. Asta, can we go? Yes. So, firstly, let's clarify a point that often causes confusion. I think one of a person has queries related to payment to connected person. There happens to be two kind of payments. First one can be remuneration, and the second one can be dividend. So let's understand with the help of one example. Say there is one person, Mr. A. He owns 100% of a company, say ABC LLC. He's also managing director and actively running the business. Now that company pays him AD 500,000 as managing director salary and AD 1 million as a dividend. So how we are gonna see these transactions from transfer pricing perspective? Would transfer pricing be applicable on both these transactions? So firstly, we will take remuneration. Remuneration is a business expense and it directly hits the P&L of a company. It reduces the income of the company, and when that salary income goes to the managing director, it does not get taxed as there is no personal income tax on salary in UE. So this gives the scope for profit shifting and tax avoidance. That's why it falls under transfer pricing rules. The remuneration must be justified at arm's length, and it should be disclosed if it crosses the reporting threshold. Now, the second tranche of the payment is dividend payment. Dividend is not a business expense, it's just a distribution of after tax profits to the shareholders. Dividends are not paid for work, but they are paid because the person owns the share. So, technically, transfer pricing should not be applicable as there is no artificial avoidance of tax being done in this case. Asa, can we move to the next slide? Yes. So now that we have understood that remuneration to connected person is subject to transfer pricing, unlike dividends, a very important follow-up question arises. Do these payments need to be reported? And if yes, how do you know when? This is something that often gets overlooked or misunderstood. So let's clear it up with a simple and very realistic example. Imagine this, that there is a company A which is paying a remuneration of AD 300,000 to its director. At the same time, it also pays AD 500,000 to a consulting company, say company B. Sounds fine, right? Now, here's the twist. The director owns company B. So now we have two separate payments, one to an individual, one to a company, but both ultimately going to the same connected person. If the total payments to a connected person and their related entities equal or exceed 85,000 in a tax year, that is the threshold limit for reporting payments to connected parties, you must disclose them in your tax return. So in this case, you have hit the reporting threshold, that is 800,000. So in this case, disclosure becomes mandatory. Now, where do I need to disclose director's remuneration, and where do I need to disclose the payment being made to company B? You can disclose director's remuneration in the connected person schedule in the corporate tax return. This basically gives the FTA visibility in how much has been paid to individuals with influence over the company, and the payment which is being made to company B can be reported under related party transaction since the company is owned and controlled by the same director. Of course, you need to see the threshold limits before reporting this transaction in related party transaction schedule. So if either of these so if the thresholds of related party disclosure is met, then you need to disclose the company B payment also. Now that we have discussed the payments to connected person, it is the time to discuss the most common way to finance group company. That is extending loan to a group company. This is the most common and most casually handled transaction between related parties. But under UE transfer pricing rules, these transactions must be handled with the same level of formality as if they were made between two completely unrelated companies. So I want to explain this with the help of a simple story or example. There is a company which is a group company in Dubai. It has provided 81 million to its subsidiary, say in Sharjah. There is no loan agreement, there is no interest being paid, there is no repayment plan. The CFO just called it as an internal adjustment. But when the FTA reviewed their related party disclosures, they didn't see it as an adjustment. They saw it as high level, high risk transaction lacking arm's length justification. So whenever you are getting into intercompany loan transaction, you need to prove to the FTA and FTA that these loans have the nature of the loan being extended to a third party. For those, you need to complete these key requirements. First is that you need to have arm's length terms and condition. The loan must be structured as if it were being offered to an outsider. So you need to ask yourself, would a third party lender offer this loan on the same terms? If not, it's not arm's length. The second and the most important requirement is the interest rate justification. This is a big one. You can't randomly pick an interest rate. or offer the loan at 0%. You need to see a lot of factors. These factors may include borrower's credit profile, loan size, security offered, risk involved, duration of the loan being offered, even the currency used. So please pay attention whenever you are extending a loan that a fair interest rate is being charged. Now, the third requirement, it is the documentation requirement that there needs to be a backed up and a return document that you are extending a loan to a group company. The loan must be documented with the principal amount, interest rate, payment schedule, tenure, security if there is any. If the FTA doesn't see a signed agreement, they won't accept it at face value. Next requirement is you need to have the repayment terms in the loan agreement also. So I have seen in many cases, in many clients cases, that they do have loan agreement, but there is no repayment term being determined, as there is interloan transaction being happened between two related parties. They are saying that it is like a family matter. We are just extending some sum of money to our group company. Why should we add that term to a loan agreement? But this is a huge mistake they are making. You need to define exactly when and how repayment will happen, be it be monthly, quarterly, or a bullet payment. But please ensure that you determine repayment term before extending the loan. Now, imagine a situation where a related party has extended a loan, and that loan is being repaid in the same year in which it was extended. Now, you will think that if we can go outside the scope of transfer pricing, but no, TP rules will still apply. Why? Because economic substance of the transaction existed. So don't skip documentation and the TP requirement just because it was temporary. So whenever you are issuing loans between related parties, please make it seem like it is happening with a third party. Asta, can we go to the next slide, please? Thank you, Asta. So far, we have talked about intercompany loans, where the risk lies in undercharging or skipping documentation. But now it is the time to move into an area where the risk is often completely invisible. That's intangibles. Here's a question for you. If your company builds a powerful piece of software but register the IP in a different group entity that had nothing to be do with the development, who should really get the income? So we are naming the company, say company A developed the software, but the ownership is with company B. Now, who should be getting compensated for its effort? I request you all to please provide the response in the chat box. According to you, who should be compensated for their efforts? Company A, who has developed the software, or company B, who is the owner of the intangible? Yeah, so the company who has put its effort in developing the software should get the compensation, should get the income out of that software. So this is what the OECD and now the FTA is saying, that the efforts should get compensated. And we are going to enter the world of DAMPI framework and see that how we can actually see the efforts and the compensation, the right match between efforts and compensation. So what is DAMPI? DAMPI is basically how we allocate profit fairly among group entities when it comes to intangible. It stands for five core functions involved in the life cycle of an intangible asset. D stands for development. That is who created or designed it. This could be your R&D or software development team. Then E stands for enhancement. That is who is that person or entity who improved it over time. It added features, rebranded it, or maybe made it more valuable. M stands for maintenance. Who updates, supports, and ensures the asset continues to work or stay relevant. Then comes P, which stands for protection. Who legally protects the asset? This includes registering trademark or patents. And the most important one, which is the common one also, E. E stands for exploitation. That who is using it to generate revenue. It may be through sales, licensing, or operations. Whoever performs any of these functions must be compensated accordingly, not just the legal owner. In other words, ownership does not equal entitlement. Contribution does. So let's understand this with help of an example. Let's say entity A in India develops a software platform. They have done all the hard coding work. There is entity B in UE, which runs the marketing and licenses it to clients and closes big enterprise deal. Now, there is entity C in Cayman Island, which is a tax haven. It holds IP and receives all the income in the name of owner. Under Dampy world, this setup won't fly. This setup won't work at all. Each of the entities involved in Dampy functions must get fair compensation. Entity C, in our case, just holding a legal title doesn't get to walk away with all the revenue. So I am going to take the most important and common transaction core part of Dampy function, that is E exploitation here. Asta, can we move to another slide? Thank you. So we just saw how important it is to reward the right group entities based on their contribution to an intangible and not just ownership. Now let's zoom in one of the most commonly used and abused intangibles in group structure. The trademark, yes, your brand name. Imagine this, that there is a multinational group which has a strong global brand. We can say, for example, call it Apple. The head office is in the UE. It owns the trademark. They have registered it, protected it, and built global recognition. But now that brand is being used across multiple foreign subsidiaries in India, Saudi, Egypt, and beyond to sell products in local markets. That's what this diagram shows in this slide. Each of these companies, A, B, C, D, is leveraging the same brand power to boost local sales. So this example in this slide is a classic case of IP exploitation. The local companies are commercially benefiting from a centrally owned intangibles, the brand. Customers buy the product not just because of its feature, but because they recognize and trust the brand. So, as we saw in the earlier slide, the Dampy slide, if you exploit an intangible in a way that drives income, you need to compensate the owner of that asset. In our case, the subsidiaries are exploiting the brand name and you generating the revenue in the name of brand name. So, this group company should need to get compensated, that too at arm's length. Now, Asta will take you to the another world of cross charge, where a single entity is making a payment and or giving some services to another entity, and how we should apply transfer pricing on these cross charge transactions. Over to you, Asta.
Thank you, Iti, for the insightful overview on TP homebound transactions. That sets a good foundation for the our next part of session. So we'll now take it from here and move on to our next topic, that is cross charge. So let's decode it together. So before talking about the cross charge, I would like you all to understand what is the intra-group services. So let's talk about something we all deal with our of daily life, of and often overlook this from a transfer pricing perspective, and this is the intra-group services. So imagine you are the head office and you're offering HR support, IT help desk, or even accounting services to your sister companies across the group. That's exactly what we call intra-group services. Means services provided by one group entity to another. Now, here's the quick key question. uh, should you charge it, or you should recover it, or you should provide it for free of cost? So let's break this down and let's understand. We split the services into two categories. So on the left hand side you will see the chargeable services, which can be either high value added, and we'll see the examples of this. Some of this can be technical services, research and development related services, or strategic management related services, or low value added services like payroll support, HR support, IT support. On the right hand side we have got reimbursement of cost. So this is where one entity simply pays on behalf of another with no real value added. Think of things like visa fee or courier charges. Simple pass-throughs. We'll decode visa fees in our upcoming slides. Now, here's the term you often hear, which is cross-charge. All it means is this: you are allocating the cost of services across entity, possibly with markup if value was created. Now, think of it like siblings splitting the Netflix subscription. One pays, others uses it. They better chip in, right? So, to simplify, if a service adds value, charge it at arm's length. If it's just a cost pass on or pass through cost, prove it that it is a reimbursement, move on, no markup is required. Let's how look at the how we will decide it's a high value added, low value added, reimbursement. Let's see. Let's now talk about the high value added services, premium category of intra group services, the ones that actually move needle in your business. We call this high value added services. So what makes them high value? Well, the services are that services which support directly to the commercial success of the business, which will require expert level of input, or even you can say that technical level of input. And most importantly, they are often core to your business model, which is akin to your which will add value to your day-to-day business. So think like this: you are a parent company, you are offering research and development services that will fuel innovation across the group. So that's not a back office support, that's a business, and that's a critical stuff. So let's look at these some examples. It will be the strategic management services. It could be the high level decision making, research and development services that will lead to new products, patents, or services, branding, high level consulting, or market entry strategies, or even technical support services. Technical services before launching new products are also covered in this high value category bucket. Now, here's the transfer pricing reality for this. You must price them means proving that what you are paying or charging is similar to what third party would have accepted. This involves benchmarking, functional analysis, and yes, intercompany agreements. And quick warning I would like to give you all that do not lump this cost with your generic shared services like HR or support, which will be classified as low value added services. Keep them separate because tax authorities will view them very differently. So if you are receiving this kind of services, be ready to justify your pricing. And if you are providing them, make sure You are charging fairly and documenting everything. Let's move further. Let's move on to uh, we have covered high powered, high stake services. Let's now move on to this low value adding services. So these are the services which are routine support functions that keeps business running, but do not necessarily boost your profits or market share. So think it like if high value services are brains behind the operation, low value added services are the backbone, essential but not that strategic. So the services which are not part of your core business activities do not require intangible support or unique intangibles. And they are the low risk and low return from the business standpoint. So let's have some example. HR support, IT help desk, payroll processing. Now, please understand if companies into business of HR support, they are providing this kind of similar services to the third parties also, and also to their related parties also. Then this cannot be treated as a low value added services. These are the commercial services. That company itself is into the business of these services. So please be mindful, do not abruptly treat this services as a low value added services just because they are having listed down over here in the low value added services bucket. We need to see it in detail. So this could be the payroll processing, visa coordination, admin or office support, internal training programs. So there is a good news for this. OECD gives a shortcut for this. Instead of going through the benchmarking and complex analysis that we would go if the services would have been classified as a high value added services, we can use the simplified approach. What is that? Just allocate the cost using the reasonable method. So now what is the reasonable method to allocate the cost? We will see this in our upcoming slides. Then apply the 5% flat blanket markup onto the allocated cost base. That's it. No benchmarking required. Just make sure, document this cost base and on what basis you have allocated the cost. On document this and maintain this on consistent basis. So, but do not abuse this. The simplified route is meant only for truly low value added services, routine services, not for strategic management, technical or research and development services, which will be classified as a high value added services. Now let's talk about the reimbursement of expenses. So this is very simple, but this can be easily misunderstood when it comes to the transfer pricing for reimbursement of expenses. So what is the reimbursement? It happens when one group entity pays uh, expense on behalf of another and later gets paid back, that is reimbursed without charging any profit or any service. uh, you can imagine like you are paying your colleague's lunch and getting reimbursed exactly what you have paid. No margin, no markup, just cost recovery. But not every reimbursement is a clean pass through. For it to qualify as a pass through under TP regulations, there are few conditions. So, what are those conditions? Let's understand them. The cost was incurred specifically for another entity. There is no value there is no value added or no service element is in that. So you are not doing anything extra, not performing any extra function, not bearing any risk. That's the key criteria. Exit cost amount is being recovered, no uplift, no profit. And importantly, paying entity doesn't retain any risk or benefit, as I said. Now, all of you will be thinking that how do we prove this? So that brings the TP treatment on the right. So no markup will be required. That's the great thing. But you must back it up with third party invoice, proof of payment, and ideal internal communication, many mail trail or even intercompany agreement will also suffice in this case. So it should show that cost was only meant for the reimbursement or pass through purpose. You are not providing any kind of hidden services in the name of reimbursement. So the big mistake we want to avoid is calling something as a reimbursement when actually there is a hidden service charge. So that's the red flag from the tax authorities. So no service, no risk, no profit. It will equal to markup, but we need to have a solid paperwork or documentation to defend our justification that this is the reimbursement and there is no service element is in this kind of transactions. So now my colleague ET will take you through the framework that we will follow for usually follow for intra-group services. ET, over to you.
Thank you, Esther. So let's understand framework for pricing intergroup services with the help of an example. Um, I would like you to imagine that you are head of a multinational group and one of your entities is in Dubai. Let's call it AB Services Limited. It handles HR, legal, and accounting for other group companies across the world. But here's the big question. How do you decide what to charge each of these companies? So there is a step-by-step model which we need to follow to decide what should we charge for the intergroup services we are providing. The first step in the first step you need to ask, has a service been performed? You start by asking, did AB services actually do something for another group entity? If the answer is no, stop right here. And if there is nothing to charge, and if the answer is yes, then we need to go to the step two. Now, did the other entity actually get benefit? If they didn't need or so now, did the receiving entity, say your Oman subsidiary, actually benefited from this service? If they didn't need or use the HR support, you shouldn't be charging them. For example, there may be like 4 to 5 entities, but you provided HR support services to 4 entities and not to this Oman entity. This entity did not receive any benefit out of these HR services. Then you will not allocate any price to this Oman entity. If yes, then we would go to step three, in which we would see would they have paid a third party. So ask yourself, would they have paid an external firm if we didn't do it in house? If yes, boom, it's a chargeable service. Then in step 4, we need to determine an allocation key for charging indirect costs. For example, 4 to 5 employees may be working for multiple group companies. Then you may allocate these indirect costs on the basis of maybe man hours or how head count. Once the indirect cost has been allocated, now it's the time to see the direct cost attributable to the one entity. Say the team traveled to Oman for providing those services. Now, the travel visa, the air ticket cost, these are the direct costs which can be identifiable with a particular entity and a service. So, you need to identify these direct costs. Cost. Now, you need to consolidate that data, that what cost base or income value is being recovered. In the last and the final step, you will see that what can be the arm's length price for these services. For low added services, you may add 5% markup and then charge it to your group entity. So remember that it's not just about charging, it's about charging fairly, logically, and defensively. And when the tax authorities come knocking, this framework becomes your best friend. Asta, can we move to the next slide? Yeah. So this is the most important slide. I really want you all to just pick up your phone and click a photo of this slide, because you need to have this slide in your phone available with you all time. This we have tried to capture the cost allocation keys for the most common transactions, or for the most common services being performed between related parties. For HR support services, it could be headcount per entity. For IT support services like help desk, software license, cloud services, the allocation basis could be number of users, devices, or licenses. Then for finance and accounting, it can be revenue, number of transactions, or hours worked. For legal services, the allocation basis can be number of legal matters or hours worked. Then the general admin support, office headcount or admin hours used can prove as an appropriate allocation basis. For training and development services, you need to allocate the cost on the basis of number of participants or employees. For the marketing and branding services, the cost can be allocated on the basis of revenue or sales generated. For another two services mentioned here, office rent and utilities and facilities, you can allocate the cost on the basis of floor area used or number of desks. Then there is insurance and allocation. You can allocate these expenses basis on value of insured asset or usage share. These are the common allocation keys used for allocating these expenses. But please ensure that the allocation basis you choose should be logical, defensible, and consistent with how the services are consumed. So, next time you build a cost sharing model, make sure that it passes. Would a third party agree to this test? Would a third party agree that you allocate cost on the basis of the allocation basis mentioned in the third column? So, we have understood the framework and the cost allocation keys. Now we will discuss what are the common cross charge transactions and expenses. This will explain. Asta will explain these to you. Over to you, Asta. Thank you.
Thank you, Iti, for this framework and cost allocation keys. So let's move on for the cases. Let's see the practical cases. First is the fees for technical services. So let's understand the case scenario. So the in this case, we have company A, which is the manufacturing entity, and company B, which provides technical design services, which are essential for company A's production which will help in building the products which is to be delivered to the third party customers. Now the question is, how do we treat this from transfer pricing perspective, that is fees for technical services? So first ask, that is this the value added service, high value added service? Yes, it will be. It's not just a routine admin or back office support. This design work provided by company B is critical to manufacturing and directly help in generating the revenue to the company A. So this is clearly core function of company A, and it is the strategic in nature. This is why it cannot be treated as a low value added service, which means we cannot apply 5% shortcut markup here. Now, transfer pricing implication will be how it will be. So the payment to company B should be at arm's length. That means pricing it like you would if you would have hired external designing firm. You will need a separate benchmarking analysis to determine the right fee. Think of external comparables for similar design kind of services. And very important, this cannot be bundled with the shared cost or charged under the generic overhead allocations. So, key takeaway over here will be, if service directly supports the commercial success, as in this case, you can see it deserves its own pricing logic backed by the data, and it will not have a 5% blanket markup. Let's move on to our next example. That is for visa services. Many of you have asked the questions regarding visa services. So let's understand. Uh, Visa and PRO services between group company. Company A, it will manage visa related work, applications, renewals, PRO tasks for company B's employees. So what will be the transfer pricing implications? So first we need to ask, is company A offering the same services to the third party? If yes, then it's not the admin work, it's a commercial service. That means it should be priced using external benchmarks, just like third party PRO firm would do. But what if company A is doing only for its group companies? Now we enter the zone of internal services. So there could be two possibilities: low value added services. When it will be the low value added services, if company A is coordinating, supervising, or doing any admin kind of work for visa processes, which will involve service element, but which is low value adding. So this will be counted as a service, and it will get the benefit of OECD's simplified approach. That is actual cost allocated plus 5% markup. No benchmarking, nothing. Now, when it can treat it as a pass-through. So if company is only paying on behalf of company B, then no oversight, no coordination, nothing is there. It's just paying, acting as a middleman. So just recovering the exit third party cost. Then it's a pure reimbursement. No markup is needed. But you'll need to prove that there was no service element in that transaction. So visa services can be supportive or commercial. The TP treatment would depend on the who is doing what and for whom. So always ask, is this value added service or just a payment proxy? Let's go ahead. Let's understand shared services. Another example, which we is it's like the it's very common. You assume you are the headquarters. You are running HR, IT, finance, admin functions for all group companies. That's your classic shared services setup. While it keeps engine the running, it's not driving the business forward in terms of revenue, because business model of the group can be anything which is not the this kind of services. So why these services will be treated as low value added services? Well, the services will be routine in nature, not directly linked to the core business or revenue generation. So this will help group companies functioning properly and efficiently, but it will not involve strategic or innovation, because this is not related to the core business function. So they are essential but not critical or high risk. Think like payroll processing, payroll support, IT help desk tickets, chatbots kind of thing, admin support, or bookkeeping, centralized accounting, and all. What does this mean from transfer pricing perspective? Again, it's a good news that no benchmarking is needed. Instead, you can simply allocate the cost using the reasonable basis that we have seen, like headcount, number of employees, system users, anything. Then apply standard 5% markup on the allocated cost base. This is the OECD's simplified approach. So yes, the services are low value, but they are not free. You still need a clear allocation logic and proper documentation to defend it. So to summarize, if it's a back support work, not strategic, not profit driving, you qualify for the simplified TP treatment. But make sure it's accurately allocated and consistently applied. Let's move ahead. Reimbursement of expenses. Let's talk about the type of transaction that looks simple but often confuses people when it comes to transfer pricing. So now imagine company A pays bills on the behalf of company B, maybe a vendor invoice, a visa fee, or some professional service arranged through the group contact. Anything could be there. So company B later pays exact cost to the company A. Now the big question, will this trigger any transfer pricing requirement? Answer is, we need to see that how it falls within the reimbursement bucket, pass through bucket. So to qualify it as a pass through cost, it must follow the conditions. So what are those conditions? Let's understand. So it should be the exit cost recovery. There should be no uplift, no margin, no services provided. There should be no service element. Company A should not be managing, coordinating, or advising. We need to document it properly. How do we document it properly? Keeping third party invoices, third party contracts, proof of payment, and internal communication like mail trail or approval trail or kind of thing, that would also work. And while it's not mandatory that it's not mandatory that you should have a reimbursement agreement, but it's advisable that you can have a reimbursement agreement for similar kind of transactions to clarify the arrangement and to defend your defend the questions asked by FTA during the audit process. So let's look at the TP implication. So if all these conditions are met, it's a pure pass-through transaction. This is confirmed. This means no markup will be required. You can only recover the cost. No TP documentation hefty burden is there. But full transparency is essential. So company A must not retain any risk, benefit, or margin. It's simply they are acting as a middleman. In short, if there is no service, no value added, no profit, you are clear that it's a pass through, but only if you can prove it. So keep your documentation tight and your reimbursements clean. With this slide, thank you all for joining us today for this session. We hope discussions help clarify the practical aspects, and this region is new to the text and it continues to evolve in its text landscape. Staying informed and compliant is more critical than ever. So be a part of our community. Scan the QR code on your screen to join our MICS local to global WhatsApp group where we discuss the updates, share insights, and collaborate on the real-time text challenges. So thank you. We are up for the questions. You can list down your questions in the comment sections.
Thank you, Astha. Thank you, Iti. I learned a lot today from you too. So I'm sure audience must have also. And I saw some messages which said that there are some technical issues with the recordings and presentations which we have been circulating. So be rest assured, we will circulate one after ending this session. And once we have completed our entire transfer pricing series, we will club everything and circulate to y'all. So y'all have your in-house transfer pricing guide for your ready reference. Having said that, I think we've answered all the questions on real-time basis, but we can take few more if they are there. Next session is going to be really interesting because it's going to be the pain point of most of the people, which is benchmarking. So do join us for the next session. We would be happy to host you all. Given that it is the last session, please do gather your queries also. All the queries you all have for us, we would be happy to answer them as well. Are there any questions in the chat box?
Okay.
No, right? Great. I think that speaks in itself for a good session. Thank you, everyone. And looking forward to see you next week as well. So generally we are doing transfer pricing Thursdays, but given that next Thursday is a holiday, we will meet you all on Wednesday to take this up. So next Wednesday at 5 p.m. UAE time. See you all. Thank you.